Okay, welcome back to Tackle Trading's Commodity Report. This edition of our report is going to be for 4/18 of 2015. Let's quickly look at the commodities that we're going to keep track of during the report. Crude oil, gold, cattle, natural gas, copper, lean hogs, palladium, platinum, silver, corn, oats, soybeans, and wheat. Let's go ahead and jump into Thinkorswim and let's talk a little bit. Now, we're going to go through these a little bit different than we have in the past. And actually, I'm going to just get rid of that chart. We're going to start right here with crude oil. Crude is going to be the first one we look at pretty much each and every week, as it is such a driver of market volatility, such an important commodity just in and of itself for the overall market. And crude had a very interesting week. You know, last week when we did the report, I called crude neutral, and it was neutral at the time. And we'd identify the resistance point at $55. And what happened is crude broke out of that. In fact, if you look forward here, one of the biggest moves of the week. On the 15th, which was tax day, on the inventories report, crude oil broke out of that number. Rally, rally, rally. Not only that, we're now looking at repricing into a new longer-term contract. You're going to start seeing crude prices quite a bit up here. Now, this week's levels that I think are very significant. Before we go too far, I'm actually going to look at crude for the June or July contract. Why don't we price, not GC, let's go to CL. Let's tie these charts together as well. Let's make this one. Let's do green for today and green here. Get them all tied in. Okay, so if we look at the July expiration for crude oil, you'll notice it's 58.86. For June, 57.73, 56.14 for May. That one's expiring. 59.40 for August, September at 59.91. So depending on which contract you actually do trade, and volume and open interest are very good metrics for you to look at. Look at the volume on those contracts. May and June are now flipping. You're seeing more contracts traded in June recently. That's why they're calling it the active contract at 31 days. Traders are starting to move forward into the June contract. We're going to call crude oil slightly bullish right now. I am still very cautious. I do believe that with the rally, those of you who know what a pay range is, we've seen significant rallies in the past, just in the last couple of months, where it's gone up for 5-6 days in a row and then had a slight pullback. I would look for a pullback back into the 55 level, old resistance, new support. It's a very common technical trading zone, you know, if you ever see this, and this is kind of what we have developing on crude. We had a breakout at 55. It took off. I would look for a pullback and a trigger around that 55 level. You know, if you can get that this week, that would be a very good entry point. Until I see 1 or 2 days down, though, I'd be cautious about just jumping on the upside. Crude oil, though, bullish. You know, some of the concerns around crude oil is just that, and one of the reasons I'm not giving it a straight bullish call, I'm just calling it slightly bullish, is because of the supply issues. If you look at the data, crude inventories are stock full. Storage is full. Supply is high. You know, they've been holding inventory because they didn't want to sell it down in the 40s. Now that it gets up into the 50s and 60s, I think you're going to see some natural pressure from the price. People are going to want to start selling that crude oil they've been storing. As we move into this summer driving season, though, there's natural seasonal bullishness to that. So there's some mixed calls in there. That's why I'm giving it a slightly bullish call on crude oil. Key level at 60 and now 55. Old resistance should play out as new support. All right, next on our list is going to be natural gas. Natural gas, last week we gave it a slightly bearish call from the overall downtrend when it had broke support. In fact, we were looking at it from this trend right here. It broke down, little bear retracement, fading trend in here. I'm still slightly bearish on nat gas. You still have a sequence of lower highs and lower lows. You know, looking at the price, the resistance point's about 275 right in here. And I'm going to actually edit my studies. I'm going to dump implied volatility, ATR, open interest, moving averages. I like keeping charts pretty simple when I'm analyzing them with a, you know, just a clean look right here, you know, when we're doing this. So anyway, price resistance around 273. That's this zone right here. Okay. And support, I've got it down at 247. Bearish retracement pattern, slowing momentum. It is trying to find a natural kind of long-term bottom. That's what they call a slowing momentum downtrend. 4 candles up into a bear pivot. The trigger for a short-term trade would actually come off of an intraday chart. If the support point and the trend failed, you see how we had this really sharp upward movement. Anything below, say, 260 on the downside, you probably got a good 10-cent sell-off there. So working in play. So keep an eye on that on nat gas. Might be a better short-term play right now. A lot of traders are actually using naked puts on natural gas as it finds these bottoms. They're selling them. You know, the options market in natural gas, I talked about it last week, is quite liquid, something you can consider. All right, next, gold. No, let's keep the current scheme. All right, gold. Last week we called it neutral, and we put support at 1180 short term. This was our drawings. Actually, I'm going to get that rectangle. We put support here at 1180, resistance at 1220, and it was absolutely neutral. You know, gold's kind of waiting on the dollar. There were some concerns about things going on in Greece and their ability to repay some of their debt obligations. Gold spiked on a few days, and news on that. As the dollar softened, gold tried to find a natural low and did pop up a few days, but it really hasn't broke range yet, and it's kind of being pinned to 1200 an ounce. And until we see a break out of this range, you got to call it neutral. Next on our list is silver. All right, silver is obviously going to be tied to the gold markets as well. Last week we gave it a neutral call with support at 15, the range of 15 right here, and resistance up at 17.5. From a long-term perspective, I'm still looking at that. If you're going to trigger something short-term, watch $16 an ounce and about $16.60 here for a short-term trade. Probably a good naked put, you know, on the ETF. You can get a lot. There's a lot of good silver ETFs, things that you can use equity options on as well. Not a great directional trade right now. Same thing with gold, stuck in the mud. If you can find some way to play cash flow around it, and this is something I dropped last time as well, if you're thinking about a hedge against some of your investments, silver's a good hedge. It's cheap. You can buy it as a physical asset as well as a paper asset. Something to consider there. Technicals, just looking very neutral, stuck in the mud with gold. All right. You know, and some of the importance of drawing those levels on, and let's get my commodities report list up. Some of the importance of just drawing the levels on your charts, it helps you kind of shore up your technical analysis, identify your trigger points so that you can draw these neutral levels. Obviously 16.5 is what we're looking at here for the silver market. Okay, next on our list is going to be, let's see, let's go to copper. Copper futures. Now, this was one that in the commodities report last week, we called it a bull triangle. We'd identified the higher low. It was one of our best calls last week. Higher low, higher low. Copper found the low, found support, triggered upward. And, you know, one of the big storylines with copper lately is out of China. And with their presumed stimulus coming down, you know, China is one of the biggest importers of copper in the world, biggest users of copper in the world, because copper is so much in construction and development and that kind of thing. And China's growing quite a bit. And so any kind of bullishness out of the Chinese economy or the expected stimulus out of the Chinese economy is going to push copper prices higher. Copper found a low here, good 3-day trigger and candlestick, trading at 280 right now. Now, still got some bullishness to the upside. I'm calling this slightly bullish as well. Targeting up here about 295, intermediate to long term. If you're a short-term trader, you might want to take it off at 287, somewhere around there. Okay. Next on our list is palladium. Palladium futures. Now, we talked about palladium last week in regards to the inverted head and shoulders pattern, you know, shoulder there, head down here, shoulder here, and we identified the level of resistance at 780. It actually broke out of that on Thursday and showing some bullishness. 790 is also another level. I like the bullishness on this. I'm going to call it a +1 bullish, slightly bullish. Long-term support down here at 723. Intermediate support is going to be more like 755. Resistance, this 790 is a key level. A lot of good upside if you can break 790 on palladium. Next is platinum. Platinum futures, inverted head and shoulders. Some of these precious metals are showing a lot of that same kind of pattern right now. 1190 to 1200 is the resistance zone that you're going to trigger on a longer term position. Shoulder here, head down here, a couple of higher lows, developing into that pressing triangle. Good breakout. We'll have good upside on that. A lot of these metals are shaping up that way. The precious metal sector outside of gold and silver, there's still some interesting patterns developing. I'm giving this a neutral call right now with a trigger at 1190 for I'm leaning on the bullish side, especially if we can get that trigger. All right, next on our list is live cattle. Oh, man. Live cattle right here. Now, this is one I want to teach a concept on right now, in that when you see these gaps, these expiration gaps, a lot of times that's just being repriced to a new contract, okay? So like the front month contract falls off, they reprice it to the new live contract. If you ever want to look at the continuous contract on like LEM5, which would be the June contract, you can right click on it from the trade tab, go down to send to, or more info on, I should say, toss charts, and then look at the entire thing, LEM5. So instead of just LE, you put in the entire thing and it says LEM5, and that way you get a continuous chart for that price. We're using this contract right here. This is the June contract for our pricing right now. Price right now is at 149. Pretty bearish candlestick there. I'm giving this a bearish call because, especially with a trigger at 148, which is that support. Resistance at 140 or 54. Not an entry point until you trigger below support, but it's getting very, very close to that. Good long-term targets down here in the 140 range, low 140s that you would go for. Pretty directional move if you can get that thing to play itself out. Big range candle right there, showing quite a bit of bearishness. Next one is lean hogs. Lean hog, same thing. You see the big gap up here at the end? That can be confusing for some traders. So what you may want to do is go find the actual pricing for the June contract or the active month. See where it says M5? That way in your chart you can put in just M5. Lean hog June contract. So it's giving you that exact month that you're going to be trading. I'm giving this one a bearish call as well. Definitely with this trigger right here. This is a lower high, lower low scenario in a downtrend with a real bearish trigger right there. I'm calling it bearish, -2. There is some presumed demand that will be coming in because of the spring and summer grilling season. There are some speculators that are believing that hogs are going to find a bottom here in the 72, 73 range. We'll see how that plays out. Technicals are showing me bearish, so we're going to leave that call right there. Corn. Now we're going to get into the agriculture stuff, the grains. All right, corn futures. We're giving this a neutral call. 365 is support. 400 is resistance. That's the range we're in. There were some bullishness there this week. In fact, if you look at the candlesticks just from this week, 1, 2, 3, 4 green candlesticks in a row. They started to pick up. There was some, speculation that strengthening cash prices in the Midwest because of, the new planting by farmers. So they're going to start selling the old grain from last year a little bit more. Well, because they're focusing on that, you're seeing some demand pop in. It didn't really do much for the price. It moved up about 10 points, 3% for the week. Had a decent week. I'm still calling it neutral, right stuck in the middle of that range. Definitely a neutral call. All right, next is going to be oats. And oats is slightly bearish to bearish. There's a lower high, lower high, lower high, lower low, lower low, a mini high or low right there. There's some mixed technicals in here, but it's fading downward. We just happen to be at the bottom end of that range, which is why it's not really an entry point. Wait for a bearish retracement back up into the high 260s, around that 270 mark. on oats. And then soybeans, 2 more. Soybeans had a 5-day rally this week. Had a good week, picking up from the bottoms at 950 up towards the 970 mark. If you look back at that chart, I'm giving it a neutral call, even though it does have an ever so slightly lower low in here. And it is fading. It's slowing momentum, and it's kind of stuck in the range. It's been bouncing in here for a long time now. That 5-day rally happened across a lot of those soft commodities, the grain-based commodities and that kind of thing. And we'll see how that shakes out coming into the next week. And the last but not least one for our commodities report today is wheat. Wheat. We talked about the inverted head and shoulders last week, okay? And it's ever so difficult to time when that thing can break out. It's still got a long ways before it would break out of that big resistance up at 545, 550. That's long-term resistance. July is the most actively traded month for wheat futures. So if you're looking at it, instead of the May active one, you may want to look at the actual July contract instead. You'll see open interest and volume were a lot higher on that contract. So you may want to consider trading July or even the July options if you do trade wheat options, that kind of thing. There's some problems in the bid-ask in there. You might have to look for something more liquid. But if we look at the chart on this, it's trying to find support. There were some worries about rainfall in the U.S., especially with a lot of the rainstorms we had around the country last week. That's why wheat prices got, kicked in the teeth here for a few days. They dropped pretty precipitously from 520 down to 490. We had a pretty good fall in there. It's trying to find some support. This whole area is a support range. As the weather changes, as we start to get new inventory numbers, I'll be interested to see this thing kind of try to kick back up in here. I'm calling it neutral right now. I'm still interested in the bullish side of this market based on some seasonality factors that I look at, and just waiting for the numbers to start shaking out and finding itself. 460, 480, 500, these levels have been support just in the last 6 to 9 months. So keep an eye on any kind of upward swing. Could be a good swing trading candidate. Okay, from tackletrading.com, this is Coach T with the Commodities Report, and we'll see you back on the website soon. Get in the game.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.